In 1930, ordinary Americans walked to their bank on a Tuesday morning to withdraw their savings. The door was locked, not metaphorically, literally. A padlock, a handwritten sign, a crowd gathering on the sidewalk outside, understanding simultaneously that the money they had deposited in good faith, the wages, the inheritance, the years of careful saving, was gone. Between 1930 and 1933, 9,000 banks failed across the United States. 9,000, not 9. 9,000 institutions, each one taking with it the deposits of families who had done everything right, who had worked, saved, trusted the system, and discovered in a single morning that trust was the only collateral they had ever actually held. But here is the part that has been deliberately scrubbed from modern financial education. A specific group of Americans lost nothing, not because they bought gold, not because they had connections or insider knowledge or offshore accounts, because they used a government-backed system that bypassed the commercial banking network entirely. A system that most Americans today have never heard of. And its modern equivalent is sitting open right now, available to anyone with an internet connection. Here is how it works, and why almost nobody uses it. The illusion of the deposit. Before we get to the escape architecture, we need to dismantle the foundational myth that keeps most people trapped inside a system they don't understand. Your money is not in your bank. When you deposit money into a commercial bank, you're not placing your property in a vault. You are making an unsecured loan to a leveraged financial institution. The bank takes legal ownership of your funds. You receive a contractual promise, an IOU, that the bank will return an equivalent amount when you ask for it. The bank then takes your deposit and lends it out, multiple times, at leverage ratios that would be illegal in almost any other industry. It invests in instruments that can decline in value. It runs its entire operation on the assumption that you and every other depositor will not all ask for your money back as simultaneously. This is not a flaw in the banking system. It is the banking system. Now introduce the FDIC. The Federal Deposit Insurance Corporation insures deposits up to $250,000 per account. This insurance exists for one primary purpose, not to protect you, to prevent bank runs by making you feel protected enough that you never attempt one. It works brilliantly as psychological architecture. But consider what happens in a systemic contagion. Not one bank failing, but multiple large institutions simultaneously under stress, as occurred in 2008 and again with Silicon Valley Bank, Signature Bank, and First Republic in 2023. The FDIC fund is not sized to handle simultaneous failure of multiple systemically important institutions. In those scenarios, the rules bend, emergency powers activate. The definitions of what is covered, how quickly, and under what conditions become negotiable in ways that the $250,000 figure on your statement does not advertise. The deposit window can close faster than you can react. The people who understood this in 1930 had already moved their money somewhere. The door could not be locked. The four-step escape architecture. In 1911, the United States government established the postal savings system. Americans could deposit money directly through post offices. No commercial bank involved, no fractional reserve lending, no counterparty risk beyond the federal government itself. When the bank runs of the 1930s began, deposits into the postal savings system surged. At its peak, it held over $3 billion, not because it offered superior interest rates, but because it offered the one thing commercial banks had just catastrophically failed to provide, a guarantee that the door would not be locked. The postal savings system was discontinued in 1967, but the principle it demonstrated, that removing the commercial bank intermediary eliminates the commercial bank's risk, has a direct modern equivalent. Here's the four-step architecture that applies that principle today. Step 1, the utility trap. Your commercial bank account is not a storage facility. Treat it as a transaction hub and nothing more. Keep only what you need for the current month's expenses in your primary checking account. Pay your bills. Run your daily transactions. Then move everything else. The moment you start treating your commercial bank as a place to store wealth, you have accepted the counterparty risk of a leveraged institution as the foundation of your financial security. The elite do not store wealth in checking accounts. They run transactions through them. The distinction is everything. Step 2, the structural hedge. The second layer is a credit union, specifically one insured by the NCUA, the National Credit Union Administration. Here is why this matters structurally, not just superficially. Commercial banks are shareholder-owned. Their fiduciary obligation runs to their investors, not their depositors. Their incentive structure rewards risk-taking that generates returns for equity holders, with depositor safety as a regulatory constraint rather than a core mission. Credit unions are member-owned. You are not a customer, you are a part owner. The institution's incentive structure is oriented toward member benefit rather than external shareholder return. They operate under a completely different regulatory framework and a completely separate insurance pool. If the FDIC fund comes under stress, the NCUA fund is an entirely separate system. They do not fail simultaneously under the same conditions. Your commercial bank and your credit union represent two different regulatory failure pools. If one pool is contaminated, the other is not automatically affected. This is not about returns. It is about structural separation. Two different institutions, two different regulatory frameworks, two different insurance systems. Step 3, the sovereign bypass. This is the escape hatch, the modern postal savings system. The mechanism that the families who survived 1930 with their savings intact were using, updated for the 21st century. TreasuryDirect.gov allows any American citizen to purchase Treasury securities directly from the federal government. No bank, no broker, no intermediary of any kind. Short duration Treasury bills, maturing in 4, 8, 13, or 26 weeks, can be purchased directly, held directly, and redeemed directly. The money moves from your bank account to the government's books and back to your bank account at maturity. While it sits on the government's books, it is not a bank deposit. It is not subject to bank runs. It is not affected by commercial bank failures. It does not require FDIC insurance because it is not a bank liability. It is a direct obligation of the United States federal government. The risk profile is categorically different from any bank account. This is precisely what the ultra-wealthy use for their cash reserves, not because they are patriots, but because they understand that removing the bank intermediary removes the bank's risk from the equation entirely. The postal savings system of 1911 did this through post offices. Treasury Direct does it through a website. The principle is identical. The government's creditworthiness as a counterparty is categorically superior to any commercial banks. The people who are not losing sleep over the stability of their cash reserves are the people who understand this distinction. Step 4, the analog. Bridge. The final layer is the one that sounds extreme until you understand what it actually protects against: physical cash. Small denominations, enough to cover 30 days of essential expenses, held offline at home in a location only you control. This is not survivalist paranoia. It is a calculated zero counterparty transaction layer that protects against a specific and entirely realistic category of risk that has nothing to do with bank solvency. In 2003, a blackout across the northeastern United States left millions without power for 48 hours. Digital payment systems stopped functioning completely. Banks were solvent. Money was intact. The infrastructure connecting people to their money had simply stopped working. During Hurricane Katrina in 2005, ATMs across the Gulf Coast went offline for days. During the 2021 Texas grid failure, electronic payment systems in significant portions of the state became unreliable. Cyber attacks on financial infrastructure are not hypothetical. They are documented recurring events of increasing sophistication. Physical cash in small denominations cannot be hacked. It cannot be frozen by a technical failure. It cannot require a functioning internet connection to complete a transaction. It is the one payment mechanism that works when all the digital rails have stopped. 30 days of small bills is not a bunker strategy. It is the same logic that makes you keep a spare tire in your car. You do not expect to need it. You have it because the cost of being without it when you need it is catastrophically higher than the cost of carrying it. In the morning of July the 22nd, 1930, a man named George Williams walked to the First National Bank of his hometown in rural Ohio. The sign on the door said closed, permanently. He had not received a warning. There had been no announcement. The bank had accepted his deposit on Friday. By Monday, it was gone. George Williams lost everything. Across town, a postal worker named Earl Hodges had been depositing his savings through the post office since 1921. He had read about the postal savings system in a government pamphlet 9 years earlier and quietly moved his money there. He walked past the locked bank on his way to work that morning. He was not in the crowd on the sidewalk. The deposit window slammed shut in 1930 before most people knew they were in danger. The modern escape hatch is open right now. Treasury Direct is accepting accounts. Credit unions are open. The 4-layer architecture is available to anyone willing to spend an afternoon setting it up. The question is not whether the system is vulnerable. The documentation on bank leverage ratios, FDIC fund adequacy, and the legal architecture of bail-ins answers that question definitively. The question is whether you act before the sign goes up on the door. Subscribe to Economic Chronicles. Stay awake in a sleeping world.